An adjustable rate mortgage, ARM, is a type of home loan where the interest rate changes over time based on market conditions. Unlike a fixed-rate mortgage, where the interest rate stays the same, an ARM starts with a lower fixed rate for an initial period, then adjusts periodically. How does an ARM work? Initial fixed rate period. The interest rate is fixed for a set number of years, typically 5, 7, or 10 years. During this period, monthly payments remain unchanged. Adjustment period. After the fixed period ends, the interest rate resets at regular intervals, usually once per year. The new rate is based on a benchmark index, such as the SOFR rate, plus a lender's margin. Ongoing adjustments. The interest rate can go up or down depending on market conditions, which affects the monthly payment amount. For example, a 5-to-1 ARM has a fixed rate for 5 years, then adjusts every 1 year afterward. If interest rates increase after the fixed period, the borrower's monthly payment will rise. If rates decrease, the payment may go down. Why choose an ARM? An ARM typically starts with a lower interest rate than a fixed-rate mortgage, which can make it an attractive option for borrowers looking to save money in the early years of homeownership. It is especially beneficial for those who plan to sell or refinance before the rate adjusts. Additionally, if market interest rates decrease, the borrower may see a reduction in their mortgage rate without needing to refinance. Risks of an ARM. One of the biggest risks of an ARM is that interest rates can increase, leading to higher monthly payments after the fixed period ends. If market rates rise significantly, the borrower may struggle to afford the new payments. Another challenge is unpredictability. Since future rate adjustments depend on market conditions, borrowers cannot always plan for exact future costs. Lastly, ARMs can have complex loan terms, including caps on how much the interest rate can increase in one period or over the life of the loan. ARM versus fixed-rate mortgage. A key difference between an ARM and a fixed-rate mortgage is that with an ARM, the interest rate starts lower but can change over time, while a fixed-rate mortgage maintains the same interest rate throughout the entire loan term. Borrowers who plan to stay in their home for many years often prefer fixed-rate loans for stability, while those who plan to move or refinance within a few years might choose an ARM to take advantage of the lower initial rate. Example of an ARM in action. A homebuyer takes out a 5-to-1 ARM with an initial rate of 3% for the first 5 years. After that period, the rate adjusts once per year based on market rates. If interest rates increase to 5%, the borrower's payments will rise. However, if market rates drop to 2.5%, their payments could decrease. The unpredictability of future rate adjustments is why borrowers need to weigh the risks before choosing an ARM. An adjustable rate mortgage, ARM, can be a great option for borrowers looking to save on initial interest costs, but it carries the risk of higher payments later. Understanding how ARMs work helps borrowers make informed decisions about their home financing options.